Hello everyone, welcome to KU Padashala. Today in this video lesson we are about to discuss basics of income tax. Income tax is one of the prominent subjects in finance. We are aware that in India there are different types of taxes prevailing, and income tax is one of the taxes. As the name tells, it is a direct tax. So, before going to study in detail about the fundamentals of income tax and income tax law in India, I think better to have an insight on the concept of tax. So, let us see what is tax. Tax is a compulsory levy imposed by the state upon persons under social considerations. Here we can identify some keywords in the concept of tax. They include compulsory levy, imposed by the state means government, imposed on persons, and imposed under social considerations. So, why it is a compulsory levy? Because every tax is levied or imposed under specific enactments. That is why we pay tax under legal compulsion. So, it is a compulsory levy and it is imposed by state. Here in India we have different types of governments: union government at the center, we have state governments and even local self governments. Each of these governments imposes different types of taxes, and taxes are levied on different subject matter, like it is in respect of income, that is income tax. It is levied, the tax is levied on wealth, it is wealth tax. When we produce and market products and services, again goods and service tax. If you have employment, you are liable to pay profession tax or employment tax, that is a subject matter of the local self government. Again we pay property tax to local self government, land tax to state government, etc. So, there are different types of taxes prevailing in India, and tax is levied on persons. See, person is a legal term here, it is defined in respective tax laws. It includes natural persons, business institutions like companies, firms, association of persons, etc. And another keyword that is noticed in connection with the concept of tax is social consideration. Actually, what is social consideration? To get a clarity of this social consideration, let us try to understand why government goes for taxation. There is a specific purpose with which taxes are imposed on people. See, both the central and state governments have different obligations and they have to meet different types of expenditures. Government has to maintain law and order in the country, ensure national security of the country, has to meet different types of expenditures in the form of undertaking infrastructural projects, then ensure the social and economic welfare of the people concerned. So, for that, or to support these activities, government needs sufficient revenue. We know that tax is one of the major sources of revenue to the state, and being a member of the society, a taxpayer is getting the benefit of these expenditures and these facilities. This is what is called a social consideration. So, consideration again it is used as a legal term it implies quid pro quo, means something in return. It is also seen in income tax as well as contract laws in India. See, coming to different types of taxes. Taxes can be fundamentally classified into two broad categories. They are direct tax and indirect tax. What is direct tax? The name tells some meaning, taxes directly paid by a taxpayer. But from the taxation point of view, it has some different meaning. When the impact and incidence of tax vested with the real taxpayer, it can be said as a direct tax. Take an example, income tax, wealth tax, etc. So, here a clarity is needed with respect to impact and incidence of tax. Both fall upon the same person. Impact here means the initial burden of tax, and incidence means ultimate burden of tax. So, both initial burden and ultimate burden of tax come on the real taxpayer, it forms a direct tax. If it is not coming on the same person, it is called a indirect tax. Take an example, goods and service tax, customs duty, etc., where what happens? In the case of goods and service tax, the initial burden of tax falls on manufacturers and dealers, and the ultimate burden of tax falls on real consumers or customers. That is why it is an example of indirect tax. So, shall move on to income tax. So, we know that income tax is a direct tax. The very name signifies it is a tax on income. In other words, it can be put as the state's share out of the annual income of persons. That means, if our annual income or a person's annual income exceeds the non-taxable limit, the non-taxable limit as per the present law is 2.5 lakhs. Means, if a person's income exceeds 2.5 lakhs, he is required to pay a share of the income as income tax to the central government. That means, a share of the income of the person goes to public exchequer. So, income tax is the state's share, the government's share out of the annual income of persons, and it is collected according to the need and requirements of the nation. Why it is so? Because the Constitution of India empowers the central government to tax the people according to the need and requirement of the nation. The need and requirements of the country changes due to different factors like population, the standard of living of the people, etc. So, with the relevant Finance Act and similar enactments, the government changes the tax rates according to the need and requirements of the time. We know that income tax constitutes a major source of revenue, particularly tax revenue to the government. It is a central government subject, but the amount is shared between center and states. And the very purpose of imposing income tax is to achieve a balanced socio-economic development in the country. Means rigorously taxing rich, and through that poor will be totally benefited. In that way, a kind of balanced socio-economic development is possible. See, coming to taxation laws in India, we have different tax laws or different sources of tax laws with which income tax administration is done in India. It includes Income Tax Act 1961, Income Tax Rules 1962, Relevant Finance Act, circulars, notifications issued by the department, and case laws. See one by one. Income Tax Act 1961. Income Tax Act is the basic enactment. It is the comprehensive law. It is a lengthy law. It was passed in the year 1961, but it came into force with effective from 1st April 1962. Income Tax Act is applicable to the whole of India. I told you it is a lengthy law. It consists of about 298 sections and 14 schedules. And coming to Income Tax Rules 1962, income tax being a direct tax is administered by a supreme agency in India. There are different authorities in the taxation and its administration in India. CBDT means Central Board of Direct Taxes is the supreme or the principal agency in India governing direct tax administration in India. CBDT has given a power as per section 295 of the Income Tax Act to frame rules from time to time for the purpose of carrying out the various provisions of the Act 1961. So, the rules framed by CBDT from time to time altogether named as Income Tax Rules 1962. Remember one thing, this is a kind of subordinate law. So, the primary law is Income Tax Act 1961. Why it is so? Because if there is a conflict of provision between Income Tax Act and Income Tax Rules, then the provision of the Income Tax Act will prevail. Then coming to the third source of law, it is the relevant Finance Act or Current Finance Act. We know that the Finance Minister of the Union Government will move a budget in the Parliament on the first working day of February every year. This is a finance bill. After having undergone sufficient discussion on the different aspects of the budget or the finance bill, with a clear majority of the Parliament, both the House of the Parliament, upper house Rajya Sabha and lower house Lok Sabha, it will be sent to the President of India for his assent. After getting the assent of the President of India, it will become a Finance Act. So, normally changes in the fiscal policy of the government, both in direct and indirect taxes, will be reflected in the Finance Act, particularly the rate of tax, etc. Then next source of law is circulars and notifications. This is issued by department from time to time, normally binding on officials. And last is case laws. Case laws here means judicial decisions. In different occasions, the different provisions of Income Tax Act and rules will be interpreted by a court of law. That again constitutes one of the sources of law with which further income tax administration is done. So, these are the 5 different sources of law with which income tax is being administered in India. Shall move on to basis of charges of income tax. So, we learned that income tax is an annual tax on income. It is further taken care of that income of a particular financial year is charged to tax or put to tax in the next following financial year, during which assessment takes place is called assessment year, and the just preceding year is called previous year. So, these are the two important terms, assessment year and previous year, respectively defined under sections 2, 9 and section 3 respectively. Shall move on to assessment year and previous year. See, assessment year is a period of 12 months starting on the first day of April every year and coming to an end on 31st March of the next calendar year. You know that a financial year spreads in 2 calendar years. So, it is a period of 12 months and income of the assessment, income of the just preceding year is assessed during this year and put to tax during the assessment year. Then previous year, it is the financial year immediately preceding the assessment year. So, again it is a financial year, so it consists of a period of 12 months starting from 1st April and coming to an end on 31st March. So, this is the basic law in income tax, that income of a particular financial year is put to tax in the coming year. So, there are two years, one is assessment year, another is previous year. We will come back to the another basis of income tax, charge of income tax is tax is fixed by the relevant Finance Act, which we have discussed. Normally, income tax rate, it is a slab rate system on a progressive basis. It is given in the Finance Act. Whether the tax rate is changing or not, that is given in the current or the relevant Finance Act. Tax is charged on persons. I told you that person here implies the taxable entity. Every law of taxation tells who is a person. Here section 2 subsection 31 of the Income Tax Act gives a definition of a person. Shall move on to person. This is the definition of a person and it is an inclusive definition. It tells these are the different taxable entities who are liable to pay income tax. So, person includes an individual, a Hindu undivided family, a company, a firm, an association of person or body of individuals, whether incorporated or not, a local authority and every artificial juridical person. So, here individual means a natural person. A Hindu undivided family means a joint Hindu family with a common property and is managed by the senior most person of the family named Karta. A company here means a joint stock company. A firm, it is a partnership firm. Then an AOP or a BOI, an association of person or body of individuals. Association of person is in the form of a joint venture. It is normally formed through an agreement. The members can be institutions or individuals, but body of individuals is formed through the operation of law, where the members are only individuals. It does not matter whether this AOP or BOI is incorporated, registered or not. Another taxable entity is local authority, a municipality, municipal corporation and so on, and every artificial juridical or judicial person. So, it includes a university is an artificial juridical person. See, a temple, a church, a mosque, etc. are the examples of artificial juridical person. So, these are the different taxable entities, they are normally put to tax. So, they are included in person. See, coming to another basis of charge of income tax is that tax is charged on total incomes. So, there are different concepts in income. So, first understand what is income, then what is gross total income and what is taxable income or total income. Section 224 gives a list of incomes that are normally put to tax under Income Tax Act. It tells about 28 incomes. So, that is an inclusive definition, but it is not easy to keep in mind all those incomes, but it gives an exclusive definition also. It tells income means money or money's worth derived from a definite source with a certain amount of regularity or expected regularity. So, income means income can be received either in cash or in kind, means money or money's worth, and it is derived from a definite source. There is a source of income, there must be a source of income. Take an example, salary is derived from a source of income, it is employment. Rent is derived from house property. Interest, dividend, etc. derived from investment. So, there is a definite source of income, and it is derived with a certain amount of regularity or expected regularity. So, regularity is also taken care of. So, income means money or money's worth derived from a definite source with a certain amount of regularity or expected regularity. Further, there are two concepts, gross total income and total income. Income Tax Act is very specific in stating that the total income of a person can be calculated under 5 heads of income. So, whatever income that a person earns can be put under these 5 heads. It includes income from salary, income from house property, profits and gains of business or profession, capital gains and income from other sources. So, income from salary is calculated by considering sections 15, 16 and 17 of the Act. Income from house property is calculated based on sections from 22 to 27 of the Act. From 28 onwards to 44, there are number of provisions with which we calculate profits and gains of business or profession. From 45 to 55, there are number of sections with which we calculate capital gain, and last is the income from other source is the residuary head of income. Incomes not falling under the first 4 heads of income will fall under income from other source, which is calculated by considering section 56, 57, 58 and 59 of the Act. When we calculate the income under different heads of income, we have different deductions available in each of the heads of income. Accordingly, we calculate income under different heads. The sum total of income computed under the 5 heads of income by considering the provisions of the Income Tax Act is called gross total income. So, gross total income is the aggregate of income obtained under 5 heads of income. This is not the taxable income. It is subject to adjustments regarding a clubbing of income. Clubbing provisions are there in Income Tax Act. Accordingly, aggregation is made. Income of some other persons may be clubbed with income of the assessee for some occasions. Then there are some provisions in the Income Tax Act concerning set-off of losses. Losses can be set off intra-head as well as inter-head. Further, we go for deductions available under section 80 of the Act. Section 80 is a very lengthy section where different types of deductions are available from gross total income. From section 80C to 80U, and number of deductions are there. After deducting these deductions, these available deductions from the gross total income, we get a total income. This is the taxable income. So, income is taxed on total income. See, there is TDS, tax deducted at source, and advance tax as per the provisions of the income tax. TDS means in certain situations law says tax should be deducted at the source of income. Example, salary, casual income, interest income, dividend income, etc., where the person paying income is responsible to deduct tax and remit the money to government exchequer. Then advance tax, it is also there as per the provisions of the Income Tax Act. Now, every person if whose income tax is above 10,000 rupees is required to pay advance tax. 15% of the tax should be paid on or before 15th June. 45% of the total tax should be paid in advance on or before 15th September. 75% of the total tax should be paid on or before 15th December, and 100% should be paid before 31st March. In that way, tax should be paid. So, shall move on to accelerated assessment. See, we know there is a basic law in income tax. I told you, income of a particular year called previous year is put to tax in the next year called assessment year. So, we have to wait 1 year. Why it is so? Because one can calculate his total income for a particular year on its completion. So, that can be assessed and put to tax in the next year. That is why this general law is normally applicable, but there are certain situations which compels tax authorities to calculate and tax income in the very same year in which it is received. So, these are the different situations or instances where income is put to tax in the very same year. Income of a non-resident shipping company. Income of a non-resident shipping company is taxed in the same year if it has no representatives in India. It reaches on a particular port in India and it will move on a particular date. Sometimes it may be within the same financial year, then 7.5% of that receipt from the business of the shipping company will be assumed as the income, and that is taken their total income and is put to tax. Second is income of persons leaving India. If the assessing authorities came to know that a person is about to leave India without an intention to come back, then he will be put to tax for his income in the very same year. We do not wait for the assessment year or the coming year. Then income of association of persons, body of individuals, and artificial juridical person formed for a particular purpose or event. So, they will be liquidated after the purpose or the event. So, income earned by this AOP or BOI or AJP will be put to tax in the same year. Again, we can't wait to the coming year. Then transfer property with the purpose to avoid tax. If a person transfers his property in favor of another with the express purpose of avoiding tax, then if it is a kind of tax evasion, if it is noticed, then income from that property will be put to tax in the hands of the transferor in the very same year. Discontinuance of an existing business or profession. If a person is doing a business, is about to discontinue it, income earned from the last date of the previous year to the date on which the company is liquidated will be put to tax in the same year. So, these are the different instances where the general law that income of the previous year is put to tax in the assessment year is not applicable. So, we shall move on to residential status of assessees. So, there are two words, one is residential status, another is citizenship or domicile status. Residential status is the subject matter of Income Tax Act, because in India incidence of tax is based upon the residential status of assessees and not based on citizenship. But citizenship or the domicile status is the subject matter of the Constitution of India. It has nothing to do with Income Tax Act. So, scope of income of a person is depending on his residential status. So, that is why what is important is we have to determine the residential status of different taxable entities defined under section 231. So, person includes individual, HUF, company, firm, association of person or body of individuals, local authority and every artificial persons. So, we need to determine residential status of each of these assessees. Then only the scope of income of assessees can be calculated. So, first determination of residential status of individuals and HUF. In the case of individuals and HUF, according to their residential status, they can be classified as follows. It is given in the diagram. They can be classified as an individual or HUF can be classified as resident or non-resident. And if they are identified as a resident, again they can be either ordinarily resident, means resident and ordinarily resident. They are resident, then ordinarily resident and not ordinarily resident. So, there are three types of assessees in the case of individuals and HUF: ordinarily resident, not ordinarily resident and non-resident. So, how can we determine the residential status of individuals and HUF? For that, we have to learn two sets of conditions named basic conditions and additional conditions. These are the two basic conditions and two additional conditions. So, come to basic conditions. Has been in India for not less than 182 days in the relevant previous year. Coming to the second condition, the assessee should be in India for not less than 60 days during the relevant previous year and not less than 365 days during the 4 years preceding the relevant previous year. That means, he should be in India for 60 days or more during the current previous year and 365 or more days during the 4 years, 4 financial years preceding the relevant previous year. So, these are the two basic conditions. So, we can move on to the previous diagram. See, first we classify individuals and HUF into resident and non-resident. So, how can we determine the residential status of individual, whether an individual is resident or non-resident? So, first consider individuals. If an individual assessee satisfies any one of the basic conditions, he is a resident, otherwise non-resident. So, we studied two basic conditions. An individual assessee needs to satisfy any one of the two basic conditions, then he or she is resident, otherwise non-resident. Further, if an individual is found resident, then we go for understanding whether his status is ordinarily resident or not ordinarily resident. For that, we move on to additional conditions. These are the two additional conditions. So, now we find that he is resident. So, he is resident in India for at least 2 out of 10 previous years immediately preceding the relevant previous year. So, out of 10 years, 2 years he should be resident in India. And he has been in India for 730 days or more, means not less than 730 days he should be in India during the 7 years immediately preceding relevant previous year. So, out of 7 years he should be in India for 730 days or more. So, these are the two additional conditions. So, now we find that one individual is a resident. Then if that resident individual satisfies both of the additional conditions, not one means none. So, both of the additional conditions are satisfied by a resident individual, he can be called as resident and ordinarily resident. If otherwise, he is not ordinarily resident. So, ultimately an individual has 3 residential status: ordinarily resident, not ordinarily resident and non-resident. See, coming to HUF, the fundamental classification whether the HUF is resident or non-resident, that depends upon whether the control of HUF, control of the Hindu undivided family, is wholly or partly done in India or not. If the control of HUF is wholly or partly effected in India, the HUF is resident, otherwise it is non-resident. If the HUF is found resident, then we go for understanding whether its resident status is ordinarily resident or not ordinarily resident. For that, I told you HUF is managed by the senior most person of the family and his name is Karta. If the Karta satisfies both of the additional conditions, the HUF can be called as ordinarily resident, otherwise not ordinarily resident. So, the residential status of HUF is determined if the control and management of the HUF is wholly or partly effected in India, it is resident, otherwise it is non-resident. And as far as resident HUF is concerned, if the Karta satisfies both of the additional conditions, it is ordinarily resident, otherwise it is not ordinarily resident. So, again here HUF also there are 3 residential status: ordinarily resident, not ordinarily resident and non-resident. But for the other taxable entities, company, firms, association of persons, body of individuals, local authority and every artificial juridical person, they can be classified into 2 categories, resident and non-resident. No further classification is done. So, residential status of a company. A company can be said as a resident company if it is an Indian company and its management, effective management is effected in India. So, a company is resident if it satisfies any one of the conditions. If it is an Indian company, it is a resident company. Otherwise, the effective management is situated in India. Otherwise, it is a non-resident company. See, coming to the residential status of a firm, association of persons and every other persons, this is the basis. Accordingly, we classify them as resident and non-resident. If the control and management of such assets is wholly or partly situated in India, they are resident. Otherwise, they are non-resident. So, this is the different provisions contained in Income Tax Act. Accordingly, we determine the residential status of different categories of assessees. So, coming to incidence of tax, I told you that scope of income and incidence of tax depends upon residential status of the assessee. Now, on the basis of residential status, assessees are classified as ordinarily resident, not ordinarily resident and non-resident. So, which are the different types of incomes normally put to tax in the case of each of these type of or class of assessees? See, in the case of ordinarily resident, every income is put to tax. So, global income is liable to tax in India as far as ordinarily resident is concerned. But coming to not ordinary resident, these are the three different types of incomes normally charged to tax. First is income accrued or deemed to accrue in India. Second, income received or deemed to be received in India. Then income derived from a business controlled or profession set up in India. So, here some clarification is needed. Income accrued or deemed to accrue in India. Income accrued means the assessee has got the right to receive the income. If the income is due for payment, he has got the right to receive. That is called income accrued. It does not matter whether he received or not. Income deemed to accrue means income is not actually due or is not accrued, but Income Tax Act treats the specific income as accrued. Second is income received or deemed to be received in India. Income received means actually received by the assessee. Income deemed to be received means not received, but Income Tax Act says that it is received. It is deemed to be received in India. It is not received in India, but law tells it is received in India. It is for the taxation purpose. Another is income derived from business controlled in India or profession set up in India. The place of receipt of income does not matter if it is controlled in India. If the business is controlled in India or the profession is set up in India, any income derived from such business is put to tax as far as a not ordinarily resident is concerned. And coming to non-resident, in their hands, these are the two different types of incomes normally put to tax. Income accrued or deemed to accrue in India, I told you. Then income received or deemed to be received in India. No other income is put to tax in the hands of non-resident. So, this is all about incidence of tax. So, we learnt the different basic aspects of income tax in India. Accordingly, one can move on to calculation of income under different heads of income, can calculate gross total income, then go for calculating total income by availing different deductions, aggregations, etc. Further, he can calculate the total tax also. So, this is all about the basis of income tax. Thank you.